On Friday, October 21st, San Francisco Fed President Mary Daly gave a speech in which she said, "I think the time is now to start planning for stepping down." Now, the market took this as the first clue to suggest that the Fed's pace of rate hikes may begin to slow, and perhaps there will be an end to the hikes sooner than previously anticipated. Now, as expected, risk assets liked the news, and the S&P rallied 5% and the NASDAQ 5.5% from the lows on that day. U.S. two-year Treasury yields, which were trading at a 15-year high above 4.6% at the time of the speech, pulled back to a low near 4.4%. Now, despite the mildly dovish tone, the CME FedWatch tool still says there's an approximately 93% chance of a 75 basis point hike at the November 2nd FOMC meeting, but now the December 14th meeting has an almost equal probability of a 50 or 75 basis point hike. Now, for context, the Fed has already raised rates by 300 basis points since the March meeting, which is one of the fastest paces in history. Now, Daly also tried to soften her remarks by stressing that slowing rate hikes was not the same as stopping, and that she still believes that the terminal rate will be between 4.5 to 5%, saying that that was a very reasonable estimate. Now, if a trader believes that two-year Treasury yields could fall from here, they could express that by selling the November micro two-year Treasury yield futures contract at 4.4 and target a move back to the psychological level of 4.00. A stop for this trade could be placed above at 4.65. This trade could make $400 if the target is reached and risks $250 if you're stopped out of your level. Now, if a trader believes that two-year yields could rise from here, they could express that by buying the November micro two-year Treasury yield futures contract at 4.40 and targeting a move to the 2007 highs of 5.10. A stop for this trade could be placed below at 3.95. This trade could make $700 if your target is reached and risks $450 if you're stopped out of your level.